what happens is that broker selling commission actually goes back to our clients, a credit in the client's closing statement. So they look at this and they go, wait, I had $1 million. I paid Brandon, but there's a credit on here. And now I have more than $1 million. I have more money than when I started, but I paid this guy. Like, well, how does this work?
Welcome to Passive Income Pilots, where pilots upgrade their money. This is the definitive source for personal finance and investment tactics for aviators. We interview world-renowned experts and share these lessons with the flying community. So if you're ready for practical knowledge and insights, let's roll. Hey, welcome back, everybody. We are here live in the Seattle studios. My buddy Ryan Gibson. And Ryan just had an opportunity to talk to an extraordinary gentleman named Brandon Bruckman, who specializes in 1031 exchanges and DSTs. Ryan, you want to kick it off from here? What's a DST, man? We just learned a bunch.
Yeah, it's a Delaware Statutory Trust. One thing that I learned is that the IRS in 2004 started allowing people who had 1031 exchanges to invest in a pool of multiple investments, and that comprises a Delaware Statutory Trust, and have the same tax deferment treatment from a 1031 exchange. If you're probably like, what is a 1031 exchange? The IRS has lines and lines of tax code. Well, section 1031 of the IRS tax code basically means that you can take property, sell it, and exchange it in like kind and defer your taxes. So it's a really great strategy of the wealthy. They use this to defer taxes. So let's say you buy like a rental property when you're younger, and you sell it and you 1031 it, and you buy another property and you 1031 it and you buy another property, and go until you die, and then your heirs inherit that property. They're going to get all the taxes that you would have otherwise paid throughout your life wiped out. And you'll get a stepped up basis, they call it. So at the time of death, they'll do an appraisal and value the property, and they'll give you that value. So if you sold it in the future for a gain, yeah, you might have to pay the taxes, but you wouldn't have to pay the taxes as you hold. So it's a really strong tax strategy of the super wealthy. So
definitely.
And common investors do it too. And
I think that's one of the most misinformed pieces, because I think most people are familiar with what a 1031 exchange is. Some are not familiar with the fact that you can do them over and over and over and over again. There's no limit to how many times you can roll, but very few realize that if you die, you actually don't have to pay the tax. Yep. So just wanted to make that super clear.
Yeah. As a real estate investor, I often see too many times like a 90-year-old seller selling a bunch of property before they pass away. It's like,
right.
Yeah, unless they have like a need for that cash, great. But like, wait till you die, and then your heirs will get it, and there'll be no tax payments. So again, we're not financial advisors, we're not CPAs, so do your own due diligence on that. But what's cool is Brandon goes into a strategy that he helps clients who have these rental properties. So how many times have you flown with a guy or a gal that has 15, 20 rental properties or a collection of properties that they've either inherited or they don't want anymore? They're tired of being a landlord. They don't want to manage it. But if they sell, they'll have a really nice gain on that investment, and they don't want to pay the taxes, and they don't want to go buy other property under the constraints, because the 1031 comes with timeline constraints.
Right.
You have 45 days to identify a property, and then you have 180 days to actually close it. And you don't want to be running around and forcing yourself to do a bad deal. Well, Brandon, he's an advisor that helps you invest passively in a DST, which is what we go deep into. So really excited about this episode as well. And we also go into OZ funds. So Tait, you
opportunity zones.
Yep. So again, 2017 tax code allowed certain communities to have OZ funds, and if you invest there, you can do tax deferment, which is really cool because you can sell stock and defer your gains from the sale of both traditional and non-traditional assets. And when I say traditional and non-traditional, I mean stocks, traditional assets being stocks, bonds, mutual funds, and then non-traditional being things more like alternatives or like real estate.
Right.
So
cool.
Great. Well, here,
I'm excited to get into it.
Yeah, I'm going to get Brandon's bio just really quick. He works for Insight Advisors. He's an investment advisor, an RIA. He runs the Milwaukee office, and he's focused on growing the 1031 DST business as well as investment clients. So they take on regular investment clients, and then they also do the 1031 DST stuff. And prior to Insight, he founded West Chapman & Co., a consultancy that assists clients in growing their business by gaining insights through data. And he's assisted large and small businesses in the industry ranging from financial services to logistics and pharmaceuticals. And I think what's most interesting is he actually worked for a hedge fund, and he was the head of fixed income financing. He actually worked with one of my investor clients on Wall Street, like during the worst time, like during the financial crisis. So he has been completely battle tested and is super conservative now in everything that he does because he's been through, literally lived through the financial crisis and kind of navigated through that. So without further ado, we're going to jump right over to our Seattle office and go into the interview. So welcome to the show. My name's Ryan, and I'm with Brandon Bruckman here from Insight Advisors. And Brandon is our RIA, that's our guest today. Really excited to talk about the ways that investors can structure selling real estate and defer or not pay taxes. And I think it's so interesting how you've created this advisory that helps investors take maybe single-family homes that they've managed themselves and got a lot of appreciation out of, and transfer that or sell those assets and roll the proceeds or the profits from the sale into a tax-deferred passive opportunity. And that's what we're going to dive into today. And not only do you set up that, but you offer like multiple ways to do that. And I think that's very interesting. Welcome to the show.
It's awesome, Jan. Thank you for having me. It's great that we're in person. We're here in Seattle. My first time here in Seattle. So no, this is awesome. Thank you.
What do you have planned today in Seattle when you're here?
Wow, we're gonna go down. We're gonna do as much tourist stuff as possible. So if we can go down to the public market, catch some fish, eat some great seafood, that would be a pretty good day.
Well, the first Starbucks ever is in Pike's Place Market.
On it.
And it's the most uninteresting place you can go, to be honest.
Not going there then. So then out. No.
Most pilots that are listening have probably laid over in Seattle and probably have wandered down to Pike's Place, a great place to go. But I always recommend the Starbucks Reserve because that is kind of a cool flagship store. They make the coffee beans there, and that's kind of a fun place to go. But well, great. Well, welcome to Seattle, and thank you for sharing your knowledge. We actually host a meetup wearing another hat for Spartan Investment Group. We host a meetup on first Fridays of every month, and we went really deep with you on all the things that you do at our meetup, and that's filmed and posted on our YouTube channel as well. We'll put a link in the show notes to that. But why don't you kind of walk us through some of the options that you provide for your clients?
Yeah, I maybe kind of spin back to when you described maybe where some of our clients are kind of coming from with the appreciated real estate. So I think the average client that we're looking at has been investing and managing real estate themselves for 20, 30, maybe even longer years, and they have highly appreciated assets. And I think from our conversations, the majority of those folks are still in the mindset of, I got two options here for myself. It's continue to manage these things, pass away, step up basis, give those assets to my heirs, or I'm going to sell and pay the tax and then go do what I want to do. These are the only two options I think in a lot of their minds that we have when we have these conversations. And we're saying, stop. No, there's other things that you can do to be more creative, to get yourself to a tax deferred situation, get yourself to that passing to your heirs with a stepped up basis, and be passive in between there, and to go do what you want. I think about one of our largest clients right now is probably at a spring training game in Arizona. It is Arizona property. And I look at not only that quality of life, but then I start looking at his health situation. He's down 80 pounds from when I saw him before he retired, right? And he's kind of cleaned up his health situation because of all the stress that he had in managing those properties.
Yeah.
So when we think about that, there's a huge lifestyle component here that I think a lot of property owners are probably missing because they feel a little bit trapped by these two options, the only options they think they have available.
Yeah, a lot of our listeners are airline pilots, and pilots that have maybe a collection of single-family homes or things that they've accumulated or maybe even inherited, and they are now in charge or responsible of running these properties, and maybe they don't want to do that for a long time. And as we know, you mentioned real estate. Obviously, the market is changing, but the market's still very hot. The market is very much up from 5-10 years ago. And so they might have that appreciation that they can take advantage of, but they don't want to pay the taxes. So
yeah, that's a huge catalyst, I think, for folks starting that. And then I think about, I described our typical investor has that profile. There's another subset of our investor that we kind of call them, we started to call them like an accidental real estate investor, where they have a handful of properties, but it's not their main business.
Right.
Like in the case of the folks listening, their main business is not running these properties. It's fine. That's their main business and what they do, or they have another W-2 or something else they're doing that's driving the majority of their income. This is something that's there and on the side. And when that starts to become very interruptive in their lives, we start to get those phone calls where it's like, I don't think I want this anymore. What can I do about this? And it's the same, I think it's the same mentality and mindset, though, of our typical investor that we talked about, where they don't feel like they have another option or something that they can do, but they certainly do. And a way to get passive.
So really, you're solving 3 pain points. You're solving the deferment or the not paying taxes, so not taking the large gain. You're solving the pain of having to be an active real estate investor and be the landlord, be the property manager, or have to manage the manager, as we say.
Yeah.
And 3, you're providing a place for the investor to put those dollars and get them working maybe just as hard or even harder than maybe what they were working on in the portfolio with a professional manager at the helm. So that's like the 3 things. Is there anything else that I missed or that you would critique on that?
If we can solve anything else, let me know. Sometimes we play my psychology minor a little bit with some folks, because a lot of these decisions become very personal.
Sure.
When we start to talk about them. But yeah, I think you nailed it. Those are the 3 things that we're trying to sort of solve for, is to just make a real big shift here. And we're trying our best to, from an economic perspective, it can be very advantageous to be a real estate investor actively. And so it's hard in many cases for us to replicate the full economics of that, right? So when folks are looking at that just on a spreadsheet basis, they may say, well, heck, I still want to be an active investor. There's more economics for me there. These decisions ultimately become non-economic very quickly. Yeah. And they start to become very much more personal and about how you want to live your life and about how you want to go ahead and make money and participate in real estate. So we're sort of having that conversation of trying to bring that to the forefront for the individual and to say, okay, have you really thought about this? In many cases, folks haven't really stepped back and thought about, well, what do I want to do with my time? Right. So we're sort of solving for that a little bit too, of having that life conversation a bit and trying to just point them in the right direction.
Sure. We're not going to dive deep into 1031s. If you don't mind, I'll give a quick and dirty.
I don't mind, no.
Okay, all right.
I'm good.
1031 exchange, Section 1031 of the IRS tax code lets you sell a property and like-kind exchange it tax deferred. If you buy something in 180 days and you have to identify it within 45 days of closing the property.
You got that right? You got the basics right.
Okay.
You're right on
Perfect.
it. And it's a great vehicle for investors to grow their wealth.
Sure.
I skipped this class somewhere at school. I went for accounting and finance, and no one explained this to me, the advantages of investing in real estate and the ability to defer that tax. These are, in essence, this is tax-free gains that you're making, and you could make if you continue to defer throughout the course of your entire life. Like, what a huge advantage to be doing that. So yeah, the 1031 exchange is this incredibly powerful tool that I think the majority of real estate investors know about that tool.
Yeah.
But gosh, the rest of the general public missed that course big time.
Yeah. So you get a client, maybe a pilot. He's got maybe 5 rental properties. He's inherited them. He's bought them. Maybe he was a military or she was a military pilot. And maybe every time they moved to a base, they bought a house and they just got this collection of houses everywhere, right? And they have appreciated. Yeah. And they don't want to manage these houses anymore. So they want to exercise this Section 1031 of the IRS tax code. So they come to you. What's next?
First step is you really got to talk to your CPA. Okay. I want to understand what that tax situation is, and you really need to too. So once you've done that and you said, okay, I do have a tax bill here and it's significant. All right, how can we go about deferring that? So then we'll walk folks through, let's do the 1031 exchange potentially, and then let's look at passive options. So the first place we take people is a vehicle called a Delaware Statutory Trust.
Okay.
That's a mouthful. What the heck does that mean? In essence, it's syndication that's been blessed by the IRS. So you're a partial owner in a larger property that, from the IRS's perspective, you own that property. It's a replacement property in that 1031. So you do the same mechanics you do a 1031, replacement's a Delaware Statutory Trust. So that's managed by another manager of that, a sponsor, we refer to them as. We'll go through and vet those sponsors heavy and to understand who can do this business and can't, who has a track record and returns, who's going to do good for our investors. So we'll place you in potentially a portfolio of that. Minimum investments there are usually $100,000. So you can quickly see how you can turn $1 million into a portfolio of different things that can be diversified across asset types, across geography. You can do that very quickly in this sort of setup. So that's option one. Option two, if we want to be a little bit more creative, is we'll start looking at opportunity zones.
Sure.
If we do the opportunity zone thing,
I want to stay on. I want to stay on the 1031.
I know you want to go with that. You want to stay. Okay.
Yeah, I want to stay on the 1031 real quick because there was a lot that you just said that I want to unpack.
Yes.
So let me get this straight. So
Yes.
I have 5 rental properties.
Yes.
I come to you, and the first thing you say is, "Did you talk to your CPA?" And there's a lot of pilots out there that aren't really in this game. They're accidental investors.
Oh, okay.
So they're gonna go, well, my CPA I don't really think knows much about this.
Uh-oh.
Would you help them find a CPA?
100%.
Okay, so you've got good referrals on that.
Yeah, we're working with these folks every single day. These folks being the CPA side every single day. So we can run a list of CPAs that we really trust that are able to execute this. They are hard to find. So I don't blame the accidental investor for not having one of these folks.
Yes.
They are not easy to access.
Yeah.
So
I mean, a pilot's tax return is usually pretty basic. It's a W-2 income. With the tax code changes of 2018, it kind of stripped away a lot of the miscellaneous deductions that we normally get. So a lot of investors aren't using that. So it's really helpful to know that you're a resource in helping kind of walk the pilot through the process of a 1031. The next thing you mentioned was kind of getting that qualified intermediary the QI, that would then help the transaction as well. And you can help glue that together as well.
100%. Yeah. So the side game here for us a little bit in doing this work is we're focused on the assets and the investments and making sure that's right, doing the due diligence. But we are playing quarterback on the exchange. Yeah. So I think I mentioned to you that almost the first thing I said when we came into the office, like I usually see 2 out of every 5 exchanges that we look at that we haven't helped with has some sort of taxable event that's going to be on there.
Yeah.
It may be small, but it's something that wasn't set up and structured correctly in the sale of that asset.
Sure.
So we will help clients go through that process, get them connected with they need a qualified intermediary. Yep. They need a third party. It's not us. We can't be that person. They need another third party in this process to hold those funds when they sell. That person needs to be a qualified person to do that and have the expertise to also help along the investor as well.
Yep.
So we know who those folks are and we can put those connections together too.
Yeah, and I highly advise or recommend that you work with somebody who knows a qualified intermediary that they've worked with, that they trust. There's a lot of scams out there and things like that. So work with somebody like Brandon who's worked with these QIs and knows that. So you get your CPA, everybody's on board, everybody's working together, and you're sort of playing quarterback and all that, really helping the pilot along, which is amazing because we don't do this every day. We fly planes every day, so we don't know exactly the process. So I think that's extremely valuable. The next part of this is you have spent time doing your due diligence on the operators that the investor now has the opportunity to roll in and invest with. So that's really important. Let's talk about that a little bit.
Yeah, and it really comes from sort of my background. So I did spend a lot of time at a relatively large hedge fund, and every single day that I was there, it felt like someone would throw something different on my desk of like, go figure this out, right? And so every day it was things that I've never seen before, right? And had to kind of figure out like, well, what is this? Does it make any sense? Is it viable or not? And so we kind of take that same experience here. And we tear this stuff apart and try to figure out, okay, first off, who is the sponsor? Sure. I need to understand who's running this. And so we will run deep background checks on them as a sponsor and individuals to understand who they are. And then what I really want is a track record.
Yep.
Show me an audited track record of what you've done. It's the scorecard of how you are as an operator. Yeah. There is nothing else that tells me how good you are other than what you've done, right? So help me understand that. So once we get comfortable with that, it's still on a by project basis for us, or a by deal basis that we're really, all right, let's dig through this deal. Is this deal viable? So we're looking at demographics of those particular areas. We're looking at supply and demand triggers on those specific asset types. We're going pretty deep on trying to understand is this thing viable or not as an investment, even if we're okay with the sponsor.
Right.
There are some sponsors we've okayed, and maybe half of their investments we're interested in. Others we're just not.
Yeah. So
it's a pretty detailed process. If I had to say from the Delaware Statutory Trust side, there's about 40 active sponsors in that space. we're probably comfortable with a little less than half of those. And of that, I would say we're probably only taking half of the deals that they're producing. So it's a very thin list that we're looking at. Unfortunately, when we look at some of the people that we do have competitors in our space, there's just a listing on a webpage of everything. And we're sort of looking at that sideways. Like, I don't know if that's the best thing that we want to show people. So we see a difference there.
Yeah, so the big takeaway here is you're vetting. This is what you do day in and day out. You vet these sponsors. You help investors through the 1031 exchange process to roll those funds tax deferred into a DST. And then the investor can now benefit from not paying taxes, not having to go run around and find another deal within a compressed time frame of that 45 days and 180 days and all that. And then they're completely passive, which might be their end goal in the investment. So I think that's really great. What happens after the investment's made? So you place the funds, you've identified this investor, and I guess maybe take one more step back, which does the investor have the option to kind of pick between DSTs, or do you kind of have one, or how does that work?
Yeah, completely have the option. So I refer to this in our Friday meetup as like, we've gone through the menu, we taste tested everything. Here's the menu, it's all good. We just have to figure out what fits for you, right? And so we're looking a lot at preferences of folks. So a lot of our investors have very differentiating opinions on diversification.
Sure.
And I don't have a magic 8-ball that I shake and say, hey, let's diversify. Like, I don't know either, right? Yeah. So we're trying to look at their holistic financial situation. And in some cases, they may want to write a big check to 2 DSTs.
Sure.
In some cases, I have an investor that had a $20 million portfolio, absolutely refused to invest more than $200K in a DST. Wow. I'm like, hey man, like, there's diversification and there's what you're doing. Like, this is way overboard. But that's what made him feel comfortable, is doing that. It's like, as long as I can give you a list of things that are still good, I'm all right with that.
Sure.
So it's a matter of us trying to figure out your preferences and then trying to figure out and really give you advice to say, hey, that's diversified or it's not. So that's sort of the selection process.
Yeah.
And you mentioned like the go forward is interesting too. So the life on these usually lasts between 5 to 10 years. Okay. On average, it's lasted a little over 8 from the sponsors that we've approved since 2004, when the IRS approved DST as an eligible asset for 1031. So 8 years is what people can expect. You can't get your money out, right? So there's no liquidity here. So that's another big conversation we have to have up front about the holistic financial situation is, do you have liquidity? Is locking this money up for this period of time a problem for you?
Yeah,
we may want to take some off the table.
5 to 10 years, no liquidity.
0.
Okay.
We may want to take some cash off the table up front. You can do that. There's no reason you can't do a partial exchange. So if you have $1 million and you're like, I really want to take 100K out, take 100K out. Pay the tax on the 100K. At least you have liquidity there that you can feel comfortable with. Like, okay, I'm in a good position.
Wow.
Right? So you can definitely do that. But we need to have the conversation about that. Okay. Many people are reluctant to have like it's like a sneaky financial planning conversation. I get to slide that in there a little bit because they probably haven't had that conversation before.
Yeah. That's amazing. Yeah, really, really a lot of nuggets there. You know, money being locked up, you can take money off the table, you can select your operator. And then after you've made the investment, distributions, they're handled by your firm?
No.
Okay.
So that's sort of a great part here is our role actively in that transaction sort of stops there at purchase of those DSTs. So the DST sponsors then are producing distributions, they're producing the tax documents, and they're able to communicate directly with the investor. We will play a role there if there's a lot of DSTs, like our over-diversified friend has a lot of DSTs. We will play a role there in consolidation.
Okay.
From a tax doc perspective, from a reporting perspective. He's like, man, am I making what I'm supposed to be making every month? Right. So we'll spend the time to do that in a reporting structure to say, yes, you're making your distributions. For most of our investors, it's very straightforward for what they're able to get directly from the sponsor. So from that way, it's very easy.
Oh, great. Okay.
Yeah.
All right. So that is a 1031 to a DST. Really neat.
Let's put that there then.
We can put that aside. Yep. So for those listeners that don't know what an opportunity zone is, maybe we'll talk about that in another episode or something. We'll dive into that. But part of the 2017, 2018 tax code changes, they did this opportunity zone where all across the country, I think it's like 11,000 counties, each got an allocation of their mayor or their governor or whatever could fight for locations within certain areas to make those areas opportunity zones to where investors were tax incentivized to build or to buy in those areas, and they get some tax deferral. And, you know, we looked into this early on, and it you know, at Spartan, and it sort of, was hard to find the right property in the right place and make it all work. And a lot of investors really wanted this because of the tax deferment strategy. And what I think is so fascinating is that you've gone and looked at 8,400 opportunity zone fund managers or opportunities, and you've narrowed it down to 12.
Yeah.
Which I think is amazing. So let's go through the same scenario. 5 rental properties.
Yep.
You have this gain. Now let's talk about the second option. You have an opportunity zone you can roll it into. Kind of pull through that.
Yeah, and I think I take people in that scenario, I take people there when we want to be a little bit more creative, one, about economics, because I think there's more economics in what you're able to do in the opportunity zone side. And also, it's very important to understand that you don't need to do a 1031 exchange to do the opportunity zone.
Okay.
And you don't need to invest all your proceeds like you do in a 1031. So if we have a liquidity problem, we can solve it with the opportunity zone. We just take the gain, invest that in the opportunity zone. The basis is yours. The rest of the cash is yours to do whatever you want with. Right? So all of a sudden we've created liquidity. That can be a huge thing for somebody.
Sure.
So the opportunity zone setup then allows you to invest that gain. It's not only real estate, so not to divert too far away from the example, but if folks are looking at gains in the stock market or any other type of capital gains they're looking at, that's a deferral opportunity for the opportunity zone as well. And that's the only game in town if you don't have real estate.
Right.
So there's nothing else you can do to defer gains. That's it.
So you took your big earnings in the stock market.
Yes.
You went to cash.
Yep. Exactly.
Now you have this taxable event.
Because you weren't invested at all last year, right?
Yeah,
right.
Exactly.
You didn't lose 30%, right?
But you can roll this tax-free or
100%.
tax-deferred into
do the
OZ.
tax-deferred. Wow. So the big thing here, though, is the tax deferral is only for a period of time. So at the end of 2026, that tax bill is due. So we're playing sort of an arbitrage economic game here of how much can I make between now and the end of 2026 to, in most cases, the best funds will provide you a liquidity option to pay that tax.
Gotcha.
Right? So am I still earning more and then paying that tax with the difference? Plus, I still have the basis. So I can take the basis off and invest it somewhere else, right? So if I want to be more, we've used this option to be a little bit more creative with the economics for folks and provide the liquidity, and then go after some hopefully higher return projects through this setup is what we kind of use this for. So again, we're gauging that investor and what their risk appetite is.
Okay.
If they're like, hey, DST is great, but it's very conservative.
Yes.
It's very risk adverse. How do I get more economics? Like, well, come on over here. So we got some options.
Have you made like a chart or a grid that kind of lays that out, where it's like if you do a DST, it's lower risk, it's a little bit lower return, where if you do a OZ, higher risk but higher return potential, you have more options in what you can roll into it, tax deferred. You kind of lay that out?
Yeah,
somewhere?
we built a calculator for investors, so we'll put their scenario in there and show them what those differences are and the economics are on each of those options. And then we'll spend a lot of time playing around with those scenarios.
Oh, wow.
Because I think the risk there it's on both sides, because all investments obviously have risk, right?
Yeah.
So nothing's guaranteed. But we'll play around with those returns a little bit more on the OZ side, because we are talking in most cases about development or private equity style investing, where the projected returns on that are a little bit harder for me to pin down.
Sure.
Right? So we'll play scenarios, we'll play high, low, and good, bad, ugly scenarios. And how does that compare? Right?
Yeah.
And so I think a lot of that modeling is much more important in that scenario than maybe in the DST side, where our bands are a lot tighter when we're thinking about return patterns.
Let's talk about the underlying asset. You don't have to go into specifics. Yeah. But let's talk about the type of thing that you would buy in a DST. Like give me like an avatar of the type of investment.
Yeah.
Multifamily, industrial, whatever. Yeah.
Multifamily. So about 60-65% of the available deals in the space are Class A multifamily in Class A type markets.
Okay.
So think like 2019 construction builds, 50 million value, Houston multifamily asset. That's the DST, right?
Yeah, great asset, core market.
Good asset, good market, right? Like very, very vanilla terms of an asset, right?
Right.
You can put anything into a DST, so nothing precludes you from putting storage in, industrial buildings. So we have, personally, we have a little bit of a tilt away from some of the multifamily at this point. That's just our preference. But you can sort of put anything in there. That's the typical what you see in a DST.
Sure. Okay. Yeah. And on the opportunity zone, what's your avatar for that?
Sure. It's ground up construction.
Okay.
The majority of the 8,400 opportunity zones, the majority of things that we saw were either ground up construction of multifamily or hotel, and it was usually on the periphery of these opportunity zones, right?
Sure,
it wasn't in the middle of your worst neighborhood in an insert city here. It wasn't there. It was usually on the edges of this.
Gotcha.
And we actually see new laws, some expansion of the opportunity zone rules in the House now that would limit some of these tracks. So I think legislators see maybe, I don't want to say abuse of that law, but maybe some fine tuning of that a little bit, right? So that's a typical investment you see there. So we don't like those,
Right.
So we're against those. So that's sort of a filter for us to eliminate that sponsor of that deal, because that's not the kind of deal we're looking for.
Yeah.
We want deals that do impact and value the community. We think that makes a lot of sense.
Yeah,
we think investing in these communities does have return for folks.
Yeah, I mean, you saw this come out, right? And these mayors were fighting for certain parts. They wanted their piece in every city. And I know even there's opportunity zones in Seattle, like Beacon Hill. I mean, still a solid neighborhood, but some of Beacon Hill is an OZ, and it's not the worst neighborhood in Seattle.
Yeah.
So maybe there could be better places that they allocate these OZs. But the government isn't perfect, as we know. And, these things, this tax code changed, and everybody just scrambled for what they could get in their respective markets. So it's not going to be perfect, but at the end of the day, it provides a great opportunity to really build up a community.
On balance, I think the program has been very successful.
Yeah.
And I think that's why we look at the laws, right? Bipartisan legislation, mind you, which is unheard of. Yeah. But we see that in the space now, where obviously it's successful. We wouldn't be talking about expanding these laws.
Sure.
Right? So a lot of good things have happened because of the laws in this space. So we're excited. I'm excited to see what the future holds for these laws. I'd love to see this expanded from an investor perspective, because we're getting very close to the end of 2026.
Right.
And so when I put those numbers in the calculator and I start taking years off, this gets less advantageous year by year, right? So I'd love to see an expansion where new investors now could also get that same sort of time period to be invested and to defer that tax a little longer.
So we're filming this on March 3rd, 2023. Mm-hmm. So let's say somebody's listening to this a year from now or 2 years from now. Are you saying that the Opportunity Zone funds won't be available as of the 2026 timeframe? Is that when they stop?
Yeah, they're certainly going to stop by that 2026, because then there's no deferral advantage for you to do that at all.
Gotcha.
Right, so it'll certainly be done by then. I think they'll be done a lot sooner. I wouldn't be shocked if by the end of the year there's very little capital being raised for Opportunity Zone funds at all.
So if they invested today, where's the money going if they've already bought these projects and they've already started these projects? Like, what happens to that cash?
Yeah, I mean, it's more projects if you're investing today, right? So we're watching the best sponsors continue to release new funds.
Gotcha.
They've filled investment in those funds. They have their projects. They still have a pipeline of deals that they really want to do. And so we're watching them launch new funds. I just don't see the next iteration of that, because the advantage of it the math's not there.
The tax code expires.
Exactly.
So on December 31st, 2026, at the stroke of midnight, I owe taxes now.
Correct.
On what I deferred and what I invested in today.
Correct. You owe taxes on what you deferred.
Gotcha. Okay.
So that's the key important point. I'll describe that, right? You only owe taxes on what you previously had deferred through the Opportunity Zone vehicle.
Gotcha.
The best sponsors in this space will provide a liquidity event, usually a tax-free liquidity event, for you to have the capital to pay that tax.
And how are they doing that liquidity event?
They're doing it a couple of different ways. They're not doing a sale. They're doing a lot of refis to do that. Okay. They're utilizing depreciation against some of the distributions there to create a tax-free event for you. So there's a couple different ways for them to do the mechanics there, so the distribution is tax-free to you. You're able to go and make that tax bill paid.
Now, on either the DST or the Opportunity Zone, before you jump in, is it sort of a mark-to-market where you can see how the funds are performing before you jump in, or how does
Absolutely not.
Okay.
Yeah, there is no mechanism. Okay. So in the form of the DST, what the sponsor will do is they'll acquire that property first. So they'll acquire that property using their balance sheet or some sort of bridge financing, and then look for investors. So you at least know what you're buying, right? I can see what it is. I have a rent roll. I have an appraisal. I have an environmental report. I have all the things that I would need to do to figure out if that investment makes sense.
Sure.
So from that way, there's a lot of transparency into what you're investing, but there is no prior performance of that property and that sponsor, or very little, right? Sort of the same thing in the opportunity zone side, a little bit more opaque though, right? I can't see at all what you're about to buy in many cases. There's a lot of black box going on there.
Gotcha.
So I really want, from our side, I really want a runway of what you're going to do. And I really want it to look like what you did before.
Makes sense.
Right? Because then I can start connecting the dots and say, okay, here's a 7-year track. Our favorite sponsor here has at least a 7-year track record of performance and of the similar things that they're doing now. I'm like, okay, I feel really comfortable with that.
Yeah, that's
right.
Yeah, that's just really, really valuable. So I got to ask, how do you make money then?
It's a great question. This is all for free. No, I'm kidding. No, it's not. So we'll charge a consulting fee on the 1031 DST side, which is actually, this will be it's very interesting and kind of in the weeds, but a lot of the DST products have a brokerage selling commission attached to them that we're not allowed to charge. So what happens is that brokerage selling commission actually goes back to our client to credit in the client's closing statement. So they look at this and they go, wait, I had $1 million. I paid Brandon, but there's a credit on here, and now I have more than $1 million. I have more money than when I started, but I paid this guy. Like, well, how does this work, right? So really huge advantage for our investors, be able to get that fee credited back to them instead of charged.
Okay.
It's a huge advantage.
Yeah, that is
So that's how we get paid in that context. We'll try to do the same thing on the opportunity zone side. They're not structured the same way. We're charging the same sort of consulting fees. We're doing basically the same work.
Okay, great. And that's paid when the transaction closes?
It's paid when the transaction closes. We don't believe in these assets and an asset under management fee.
Yeah.
Because once you get to year 5, what am I managing if there's no liquidity? There's something for me to manage.
Right.
If there's liquidity, yeah, there's a decision for me to help make. And in that way, we would kind of flip to an asset management structure. But I'm not managing anything here, right?
That's a very, very reasonable approach.
Yep.
Very favorable.
Our work happens up front, so we figure we charge up front for that work. And in many cases, because of the way we're structured as an RIA, it's extremely beneficial to our clients, these products.
Sure. What else does your firm do?
Oh, yeah, there's other stuff that we do too. There's 200 plus clients that are on the investment side of our equation too.
Okay.
And we approach that very differently.
What's your AUM at? Do you know?
Today, can I even tell people what our AUM is at today?
Well, you can go on.
It's all Josh's side of the equation. My partner, Josh Wright in Kansas State, manages a lot of that. It changes day by day. But I mean, I think the important thing is there's 200 clients there, give or take every day.
Wow. It's impressive.
And I think our approach there is a little bit unique and different too. So on that side, we're taking very much a trend following type of approach. And that means something to maybe some of our listeners, others maybe not. So for example, this past year, we spent most of our time out of the public market. So investors left that market and only re-entered in December. Okay. So we did the same sort of thing right before March 2020. We exited investors from the stock market. So we will take an approach that is more active in the market instead of sit back and hold and you can't time the market. We don't believe in these things at all. And a lot of them are born out of my experience at hedge fund and a lot of born out of studying folks that have been very successful in markets. We think that can be applied to all folks in the way that we're managing their money. So to us, it's very important for us to look at goals and say, all right, what type of return do we need to make to reach those goals? That's why we invest. That's it, right? So we're not trying to, if we're being the market or not being the market, we don't really care. We're really trying to avoid giant losses because that's just detrimental to a plan, and that's our big focus.
Yeah, that makes a lot of sense. Well, that's great.
Yeah.
So tons of information that we've gone through, and I really appreciate you coming on to the show and sharing with us. How can our listeners get in touch with you?
Oh, thank you. Thank you so much for having me on. I really appreciate it. So easiest way is Brandon at investwithinsight.com. Just shoot me a message. I'm pretty active on LinkedIn too. So just type me in there. Drop Brandon Bruckman in a browser and I just searched it and it was like, oh, okay, this is good. Oh, good. I'm on there. It's not some other
nothing bad.
Nothing bad. No. Very easy to find. So just do that. Yeah. Shoot me a message. That's the easiest way.
Great. Well, thank you so much.
Thank you, sir.
And
it's a pleasure.
Yeah. We'll talk to you soon. Thanks for everybody for listening.